commodity loans, etc., have also channeled credit to hitherto individuals and small businesses that were not deprived of credit. So all of that at some stage begin to percolate down to the real economy and supports the economic activity. So we don't really take cognizance of these measures because establishing one-to-one correspondence between these measures and actual growth rate in a quantitative sense is difficult, but over time they all accumulate, they all add up to create a dynamism in the economy, and that is what we are seeing. And naturally, in a global comparison, we are doing quite well in terms of the annual real GDP growth rates. As Dr. Govt pointed out, the agricultural growth rate was 3.5%. Both manufacturing and services have done very well. And the manufacturing numbers accord very well with the second quarter bottom-up corporate data we have seen in terms of top line and bottom line recovery as well in manufacturing companies. And as the slide shows you, export share is the highest in the last 8 quarters, and the consumption share of GDP is at 62.5%. So India remains an important market for other countries as well, where India's growth actually supports the growth of other countries because our consumption share is high and we continue to import products as well. So in that sense, India's growth is a net positive contributor to global growth as well. And what about the coming quarters and how things look? And that is the next part of the presentation. Agricultural activity remains robust. Rabi, it is driven by higher sowing in major crops such as wheat and gram. So you can see that year-on-year growth rate is 19.9%. Gram is about 8.9%. And all the green color bars are either the same or higher than the bar for calendar year 2024. The final estimates for agricultural production in 24-25 indicate a record output of food grains led by rice, wheat, maize, and moong. Rice procurement for the current Kharif marketing year has exceeded last year's levels. The availability of inputs remains comfortable. The record high reservoir levels also naturally augur well for rabi sowing, which is what we have seen on the left side. Now, how is the momentum in the economic activity looking now that we have 2 quarters under our belt? And as MOSPI's data show, the first half of the financial year have recorded a real GDP growth of 8%. So now we can say comfortably that the full year growth will be either 7% or to the north of 7% rather than to the south of 7%. So that is basically, we are saying growth rates will be at least 7% in real terms for the full financial year 25-26. Now, if you look at the numbers for October 2025, e-way bill generation has grown 8.2%, although it is lower than the pre-COVID average, or for that matter, FY24-25. I think it is still a healthy growth rate. Non-food bank credit, which was in single digits in recent months, has begun to pick up. 11.1%, higher than the pre-COVID average, but below 24-25, but comfortable level of 11%, higher than the nominal GDP growth rate. Electricity consumption was lower because summer months were not that hot and there was excessive monsoon rainfall, and also now we have a fairly early setting in of cooler weather. So electricity consumption is something that we need to watch out, but it could also signal energy efficiencies beginning to come through. And petrol and diesel consumption is kind of growing at rates which are not too far lower than the long-term average and the near-term average, because it also includes the fact that prices have remained stable. So it is entirely driven by volume growth, which is not a bad thing. So overall, I think the picture looks one of steady growth into the third quarter. And if you look at other indicators such as PMI and fleet activity also signal ongoing momentum. PMI manufacturing is at 59.28. Core industries growth rate was flat in October, but in Q2 it was 4.5%. PMI services higher than last year, higher than the last 4 years average pre-COVID. Port traffic is growing at a very healthy rate. Domestic air cargo was down in October. Railway freight traffic in line with the pre-COVID average roughly. Hotel occupancy rate not yet available. So overall, I think, again, as I pointed out, even in the manufacturing sector, which we saw in the second quarter numbers backed up by bottom-up corporate data, these indicators can augur steady growth as well. In the services side, we'll come to the fact that merchandise exports were lower year on year by 12% in October. I think there is an impact on the of the higher tariff by the United States imposed on Indian goods, and naturally, despite the stellar efforts by exporters to find other markets which have offset the tariff impact, but there is naturally still a residual negative impact, which is what you see in the merchandise export growth rate of minus 11.8%. And the same thing can be mentioned in the case of non-oil, non-gems and jewelry exports, which are slightly better than the overall merchandise export contraction. Total import numbers signal a healthy growth rate, and Dr. Garg also pointed out import of machinery equipment was in double-digit growth. Net inflows in terms of services, again, very positive. Steel consumption, 2.6% in October, but first and second quarter growth numbers were very good. So naturally, there is some sort of consolidation or pullback there. Cement production continuing the good trend of the first two quarters. And the same is the case with the construction and infrastructure goods, which grew at a healthy rate on a quarterly basis. We don't have monthly numbers here. Rural demand remains very resilient based on available indicators. And as the GST rate cuts begin to filter through to the economy, we basically have to make sure that the full impact of GST rate reductions will come through in the data for the coming months as well. Three-wheeler vehicle sales, after 9.8% growth, is recording a 5.9% growth in October. Tractor sales doing very well after two very good quarters as well. So overall, I think rural demand remains resilient. When it comes to urban demand, it is gaining traction post-GST rationalization in terms of UPI transaction growth, passenger vehicle sales, domestic air passenger traffic. These are beginning to recover after contraction in the second quarter, partly in anticipation of the GST rate cut expected after the announcement was made on 15th of August. In terms of investment spending, as Dr. Garg pointed out, the union government's capex grew 30.7%, and the overall investment rate more than 30% in the economy. GFCF, the gross fixed capital formation, if you look at the expenditure-wise data, that is also showing a healthy number north of 30%. IIP capital grew 5.3%. Similar, more or less in the same ballpark as last year's numbers. Capital goods imports, healthy rate of 5%, and sales of listed private non-financial companies recovered, and to an 8% growth rate in second quarter in the fiscal year compared to 5.5% in the first quarter, and also compared to 5.4% last year. In terms of inflation, October inflation was 0.3%. Food inflation was -5%. We haven't seen these numbers in a very, very long time. Core inflation rate is well below 5%, it's 4.3%. And the Naukri jobs peak index in October showed a contraction after two very decent first and second quarters this year compared to the last year, second quarter, which was very anemic at 1.3%. So overall, I think the employment situation remains steady. Now, obviously, we are also not reckoning with the major economic reform measures and policy measures